Hello and welcome to the tax roundup for April. And finally a deal has been done to pass the enterprise tax bill, and that will mean for this financial year company tax rate reductions for small businesses and a change in the threshold for access to that small business entity concessions up to $10 million. So Ray is going to take you through that a little bit later. Then we're going to look at some cases and why the ATO at the moment has a real thing for travel expenses and deductions and why you need to be careful with your clients. We're going to look at a case that explores the margin scheme and options, and another case that looks at central management and control, a very important one, and why you should look more deeply into that whole issue. But first up, we have Bradley Beer from BMT with our tip of the month. Across to you, Brad.
Let's talk about split depreciation schedules. When there's more than one owner of a property, what we do is we can split the depreciation schedules up, and what it does is help to maximise the deduction for each of those clients. When you own part of a property or part of the assets, what we do is actually split the value of the assets and then apply the rules. So when someone owns less of a property, things will drop into low value pools or get claimed at 100%, and what it actually means is more deductions in the early years for each of those owners. Now, a split depreciation schedule is not always wanted by the accountant, so we do them split, we do them non-split. Whatever you want is very easy at the touch of a button to actually change between those split and non-split depreciation schedules. Split depreciation does mean a little bit more deductions for the clients, so we've got the facility there to help maximise those deductions.
Now across to Ray for the enterprise tax bill and the detail of what's contained in those amendments.
A deal has been struck to pass the enterprise tax bill, which contains all those small business entity measures that were announced in last year's budget. So included amongst this is the increase to the small business entity turnover threshold to $10 million for a range of concessions, excluding the small business entity concessions, which will remain at $2 million. Also included is an increase in the small business income tax offset that's available to individuals, and that goes up to 8% from 6%, but remains at a $1,000 cap for the 2017 tax year. The corporate tax rate for small business entities reduces down to 27.5% for the 2017 year. That's also matched with a reduction in the maximum franking credit that can be attached. That's a difference from the 2016 year, where the corporate tax rate dropped, but the franking credit availability remained at 30%. Now, we also have an introduction of a base rate entity concept. So this is an entity that carries on a business and has an aggregate turnover of less than 25 million. So those entities will have a reduced corporate tax rate for the 2017-18 tax year, no change for the 2017 year, and then from the 2018-19 tax year onwards, that base rate entity turnover threshold will be increased to $50 million. So you have a slightly different tax rate for them, and then any corporate tax entity that has turnover of over $50 million will just remain with the 30% corporate tax rate that we have in effect at the moment. So very good news for small business entities. So given that we're less than 3 months from the end of the tax year, this might be a really good opportunity for practitioners to look at their client base, determine which additional taxpayers may now fall within the definition of an SBE, and have discussions with them regarding how they can take advantage of those concessions that are available and do some planning before the end of the tax year.
Now, the enterprise tax bill has not passed Parliament as yet, but it has passed the Senate with amendment, and now it goes back to the House. And the next available date to pass that bill is the 9th of May, which is also budget day, and we expect it will be passed on that date. The issue of central management and control comes up quite often, and this case proves why it's very important for accountants and advisors to look at the detail of where control is actually held.
Now, the ATO has released a new draft ruling dealing with the issue of central management and control for foreign companies that were trying to figure out whether they're residents of Australia for tax purposes. Now, this follows on from the High Court's decision in the Bywater Investments case, and you might recall the main issue there was we had these foreign incorporated entities. The ATO was arguing that they had central management and control in Australia, that they carried on business in Australia, and they should be treated as Australian residents. The taxpayers argued that all the board meetings were held outside Australia, that central management control was offshore. The court found, though, that really the high-level decisions for the company were actually made in Australia by the Australian accountant, and they were simply rubber-stamped overseas by the directors. So the ATO has withdrawn its previous ruling dealing with this issue of central management and control for foreign companies and has released a new draft ruling which picks up a lot of the comments from the Bywater Investments case. Now really what the ATO is getting at here and what the court is getting at is we need to look at who is actually making these decisions, these high-level decisions around the strategy, I guess, of the company. The fact that someone has the legal power or authority to make those decisions doesn't mean that they actually do make the decisions. So you need to go a step further, not just who are the directors and where do they sit when they're having their board meetings, but is there someone else or another group of people who are actually making the decisions and the directors are simply rubber stamping those decisions without being the ones who really do make the decisions. Now it makes life more difficult because it means you need to look a bit further and dig a bit deeper to figure out where central management and control actually takes place. But this is consistent with some other developments that we've seen in recent years. For example, in the area of trusts under the small business CGT concessions. There's a case a few years ago looking at where decisions were being made when it came to trustees making decisions. And the court in that case said, again, it wasn't necessarily the director of the trustee company. It could well be someone who has no formal title or role with the trust or the trustee company who is actually making the decisions, where someone else is simply rubber stamping or signing off on those in a formal sense. So it really is another indicator that we need to dig a bit deeper when it comes to some of these issues. The fact that a company might be incorporated overseas, the directors might be non-residents, the directors might have most of their meetings overseas, that doesn't automatically mean that this company is a non-resident company. It could still be brought in as an Australian resident if it appears that real decision making happens here in Australia.
Now across to Ray, looking at that margin scheme case and the issue of whether options are included or not included.
Now in the Whitby Trust case, we're looking at GST and the margin scheme. So what happened is the trust had an option over land, it exercised that option, acquired the land, subdivided it, and sold it off in blocks, applying the margin scheme to those later sales. When looking at the consideration it paid, it had included the option fee plus the value it actually paid for the land. However, for GST purposes, the option fee is a separate supply to the acquisition of the land itself. The Commissioner had previously considered this in GSTD 2014-2. However, this case goes through a little bit more detail and confirms the Commissioner's view that the option is a completely separate supply than the supply of the land. So therefore, for GST purposes, the Whitby Trust was not allowed to include the option fee in its consideration. Now, it's important to remember that is the outcome for GST purposes. It's a different outcome for income tax purposes and also for the view of the state revenue authorities. So it's very important to consider, although this is an important GST case, that does not apply to all ranges of factors within the transaction.
But now across to Michael, talking about travel expenses and deductions and why the ATO is having such an issue and pursuing these cases so hard at the moment.
Now, we're seeing more and more cases dealing with travel expenses and whether taxpayers are actually able to claim deductions for their travel costs. And this month we've seen another one, Davey and the Commissioner, which was a tribunal decision which looked at someone who had claimed quite significant travel expense deductions through their tax return. They claimed them on the basis that they'd received a bona fide travel allowance. Now, the problem here, and it possibly was the thing that triggered the ATO to have a look at this in the first place, was that they had the deduction, but they didn't put the allowance in their assessable income. Now, the taxpayer claimed that was an oversight. They meant to, they just didn't do it, but it led to this bigger issue in terms of were they actually entitled to the deductions in the first place. Now, in this case, the taxpayer ended up pretty much losing the case, and it came down to lack of evidence and inconsistent evidence. And it's a common theme. Many times where taxpayers lose out, it's because of the evidence that they have, and it's not sufficient, it's inconsistent, and it just doesn't support the case that they're trying to make. And this is yet another one of those. Now, what the tribunal did was work through some of the basics when it comes to claiming travel allowance deductions. There's a few points that are really worth remembering because this is an area that the ATO is looking at very heavily and very closely at the moment. So in terms of protecting your client's positions, there's a few really important things to remember, and the tribunal points those out for us. First one is just because you receive a travel allowance, that doesn't automatically entitle you to claim travel deductions. You need to look separately at the deductions and see whether they qualify under general deduction provisions or some other provision. So receiving a travel allowance doesn't equal claiming deductions. The two things are quite different. If you do receive a bona fide travel allowance and you spend money on travel expenses, food and accommodation, that sort of thing, then you might well be able to rely on the substantiation exception within the rules and rely on the Commissioner's reasonable rates. Now, when you're using the Commissioner's reasonable rates, again, the Tribunal makes a basic point, but an important one. If you start travelling at lunchtime, well, you can't claim the amount for breakfast because you weren't travelling at that time. So this was one of the issues actually in the Davey case, where the taxpayer appeared that they had just lumped in full day amounts, where in some cases they're only travelling for part of the day, and that was something that the Tribunal picked up on in terms of inconsistency. The other thing that is really important to remember is that even if you can rely on the ATO's reasonable rates, while that means you don't have to satisfy the normal substantiation rules, you don't have to have tax invoices and receipts for all your expenses, you still might be expected to justify how you've claimed your deduction, to show that you've actually incurred the expenses and to show that they were actually deductible in the first place, that they were incurred in the course of your income earning activities. And this is the bit that seems to often get forgotten, that when people think that they qualify for the ATO reasonable rates, they think, well, that's it, we don't need to keep any records, we just claim these amounts in the tax return. It's not quite the case. The ATO ruling makes that quite clear, and the courts and the Tribunal are making that same point, that you still need to keep some records. It's just that the level of expectation is a little bit lower than it would otherwise be. So given the ATO's heavy focus in this area, the fact that taxpayers keep losing these cases when matters go before the Tribunal, it needs to be a wake-up call that as practitioners we need to be advising clients of what they need to do to justify their claims and put themselves in a good position that if the ATO comes along and reviews their claims, they've actually got a chance of success. And with no records, you have very little chance. So again, another good warning in terms of the court or the Tribunal saying this is what you need to do, this is what you need to look at in order to be able to substantiate those deductions being claimed.
And that's the tax roundup for this month. It's only going to get busier from here on in, so if your firm is not a member of Knowledge Shoppers yet, and you could do with a little more resource support for your team so you don't have to answer all those questions, then give Julie a call on 1800 800 232 and see what Knowledge Shop has to offer. It could just be that certainty you're looking for. Speak to you soon.